Thank you, Mr. Chairman. In 1988, a very young lawyer from New York, that's me, arrived in Zug, Switzerland to meet the mysterious Mr. Mark Rich. In those days, Zug was a very small village punctuated by a lovely lake on the seafront with excellent fish restaurants, but just about nothing else. The fact that the urbane, sophisticated, and wealthy man like Mark Rich would settle in a tiny little place, bereft of cultural offerings of New York and London, was of course imposed on him after being indicted in the Southern District of New York for tax fraud in violation of the Trading with the Enemy Act. However, whilst Canton Zug was protecting him against the wrath of the USA justice system, it was also a very clever way of creating a physical commodity jurisdiction that was minimal on tax and was permissive and secretive. We all talk about how amazing Ivan Glasenberg is, and he is. It's true. Even back in the 1980s, he was something very special. However, it was Mark Rich and Pincus Green and their mentor Ludwig Justison that created Glencore that we know today and made so many men very wealthy. The Nazis killed off most of the German Jews in the early 1940s, but those that survived became successful in the science, arts, and commerce. We all know that the creators of the Manhattan Project that made the USA a nuclear power was achieved with the efforts of German-speaking physicists from Central Europe who fled Hitler's Germany. The same community created what we now know today as commodity trading in its modern form. When I joined Mark Rich & Co. AG in 1988, it was a secretive and inward-looking company that was almost entirely made up of young men, primarily from Western Europe, South Africa, North America, and German Swiss. We had offices all over the world, and our balance sheet was very modest by today's standards. Trading was less about financial arbitrage and more about information arbitrage. Every morning when we arrived at our desks before 7 a.m., we would have reams of telexes from Singapore, Hong Kong, Caracas, Johannesburg, Nairobi, and Stamford. There were no computers except in accounting, and the fax machine was very new and not really used except for documentation. Yes, Mark Rich was a very rich company that paid unusually large salaries and granted shares in the company, but we rarely provided financial products that are on offer today. Money was made with the fundamental understanding that information allowed our company to cash the arbitrage between different markets. Copper, barley, crude oil, and ferrochrome all had different prices in different geographies, and local currencies were often subject to exchange control. We also had an excellent chartering department that moved bulk commodities across markets, creating massive profits, all with very little corporate or personal taxation. Perestroika and Mark Rich and the breakup of the Soviet Union were a perfect match. The backbone of the Soviet and Warsaw Pact trading was the convertible ruble, and from 1989 to 1990, the system collapsed, and the trading system run by gray Moscow bureaucrats ceased. War materials such as aluminium, chrome, copper, coal, and iron ore were trapped there, and it was no longer a legal or financial system that allowed the steel mills of Katowice, Poland, to buy steel-making raw materials with Soviet legal contracts to pay for in convertible rubles. We not only paid for the underlying commodity, but we at Mark Rich paid workers' salaries, we paid for power, we paid electricity, warehousing, port facilities. The system literally collapsed in 1991, and there was an obvious arbitrage. The genius of Mark Rich & Co. was that it recognized this opportunity quickly and was willing to take substantial risk in order to exploit the differential pricing between markets. I was personally dispatched to Kazakhstan, Ukraine, and various parts of Russia to source steel-making raw materials for Poland, Czechoslovakia, Hungary, Romania, and spent several years traveling between those markets. The Soviet rail gauge was different to Western Europe, but often extended deeply into Central Europe, specifically for the Soviet Union to dominate these countries both militarily and commercially. At Mark Rich, we physically transported many millions of dollars of cash each month and bought up capacity on the rail and also in the ports of Ventspils, Reni, St. Petersburg, and all the various Soviet eastern ports. In 1992, at Mark Rich, we had different offices throughout the Soviet Union, including Moscow, Kiev, Almaty, Tashkent, and Baku. And we were prepaying for power and all the things that I mentioned before, including medical care. This allowed us, for example, in 1992, to buy silicon metal in Krasnoyarsk smelter for $175 FOB Ventspils and sell the same material in Pittsburgh for over $3,500 per ton. I think you'll agree, a phenomenal arbitrage. Also in 1992, there was a rise of Russian oligarchs and the death of the Soviet system managed by the nomenklatura. Boris Yeltsin, with the aid of Anatoly Chubais and Yegor Gaidar, through a system of vouchers, privatized the socially owned assets of the Soviet Union. Abramovich, Deripaska, Friedman, Khodorkovsky, Berezovsky now took control of the mines, the metallurgical works, oil and gas fields and refineries, and closed off most of the arbitrage that we enjoyed in 1998, until 1998, and the party was over for other persons other than this elite group of men. I feel privileged to have both observed and have been part of that history and that social and political revolution. It was amazing that a 25-year-old New Yorker, and many like me, could have done anything like this in the absence of the massive chasm and the resultant dislocation. However, whilst it was incredibly remunerative for us Zug residents, and then the oligarchs, there was an increasing chaos and discontent in the former Soviet Union, punctuated by the Russian crisis in 1998, with the failure of the Russian banks and the collapse of the ruble. A very clever company led by survivors of the horrors of World War II created a powerful trading paradigm that is the gold standard today, and whilst adjusted to the current reality of no-cost capital, continues to make its participants wealthy. The period between 1988 and 1998 is a specific, non-repeatable opportunity that made many Russians and Swiss billionaires, whilst the assets of the Soviet Union were being transferred from social to private ownership. Arguably, the rise of these efficiencies and the consolidation also led to the Putin era, where we are right now. President Putin's tweaking of the Russian system has created a domino effect that has manifestly made investment in Russia largely unattractive. I am sure that we all have our opinions about what happened in Russia and the 12 other republics. But what is indisputable is that under President Putin, Russia has revised as military power, albeit with a weak economy. There is no doubt that deals are getting done at the production level, especially in with Western European banks that can deploy structured debt at above 5%, with Western off-takers who assign such contracts to the bank. However, Russia and the former republics of the Soviet Union must compete for capital with Latin America, Asia, and Africa, and presently it does not. Consequently, there is a material degradation of the infrastructure in the regions, particularly in Russia and Ukraine. At Talex, our typical deals are between $10 and $50 million, and we deploy private equity and structured physical offtake contracts. We are focused on precious and base metals, and most of our current deal flow is in Peru, Chile, Mexico, Colombia, and the United States. We also have closed deals in Africa, Australia, and Europe. The structures are very different than they were 30 years ago, but the basic principle remains. Capital is looking for a risk-adjusted return. I am looking forward to meeting the various delegations here today and to investigate whether we can leverage off the success we're having in the Americas with private equity and physical offtake to create some opportunities in Central Asia. Whilst China has an assertive foreign policy that often allows SOEs to invest in the markets without regard to the hard analysis of risk-adjusted returns, institutional money in New York, London, and Zurich cannot avoid such hurdles in the underwriting process. Further sanctions, financial laws such as KYC, anti-money laundering, and anti-bribery acts further complicate matters. I don't believe these are insurmountable, but it is certainly a factor in making countries like Peru, Mexico, and Colombia more interesting today than Russia, Mongolia, and Uzbekistan. It's not that these countries have more interesting natural resources on the offer, quite the contrary. It is that they've spoken and communicated a language that capital understands. Lima and Bogota and Mexico City, whilst replete with poverty and inequality, have a burgeoning middle class and growing economies, all driven by natural resources, and are very efficient and productive workforce. Young people are now in those countries are increasingly staying and not running off to Miami, Los Angeles, and New York as they did 5 years ago. In sum, Mark Rich and Co-AG of the 1980s was all about information arbitrage and a tight-knit group of men that monetize the difference in value and prices between countries, currencies, and continents. Glencore and its copycat companies like Trafigura, Mercuria, Gunvar, Vitol have taken a big chunk of that model and have tailored it for the 21st century and transformed information arbitrage into financial arbitrage. That model is working very well in the African and Latin American continents, and those regions, especially LATAM, have reaped the benefits sowed by Ludwig Jesselson and Mark Rich. Let's work together to present opportunities from your countries and regions that will unlock the vast ocean of capital. There's a language and a cadence that must be respected in order to access this money, and together we can make that happen. It's happening in Latin America, and there's no reason why it can't happen in Central Asia. Thank you.